I was just sitting here thinking, and I'm thinking about wealth. And I'm thinking about what it takes to carve up your life's financial future, and how do you do that? Do you do it in bite-sized little pieces? Do you just chop it right down the middle and say half and half? And how do you build your portfolio? What's the most optimum portfolio? There's so many thoughts that go into my mind when I think about investing. And it's not just because I was an advisor for 16 years and I literally went to so many trainings and so many consultants telling us the most efficient way to invest people's money. But let's get down to the root of investing. Do you invest for the short term or the long term? Now, I know what you're already thinking. You're like, Doc, Chris, you invest for the long term, always. If you invest for the long term, you almost can't lose money. That's what most people say. It's not guaranteed. There are no guarantees in investments because investments involve risk, every one of them. There's not an investment that exists without risk. But time mitigates risk. So should you invest for the short term or the long term? And whenever you decide which one is best for you, what's the most effective strategy to go about that? That's what I wanted to cover today, but I'm gonna throw some hooks in there because I'm gonna tell you something that you don't maybe wanna hear and something you don't know. Something that you live with every single day, something that's inside of you, something you were born with called human emotion. It's one of the most powerful things there is when it comes to investing. So let's get into what is the perfect investment strategy. Is it go long or go short? Josh Allen should have went short last night. My name's Chris Naugle. This is What Now? What's next? So, investing for the long term. It's an interesting thought, right? What is long term to you? I will tell you this, building wealth is a marathon. Much like life. Life's a marathon. Like, you don't rush and sprint through life, do you? You miss all the good stuff. You miss all the journey if you sprint through things. So when you're trying to become wealthy and you're trying to build up your riches, do you sprint to it? I mean, there's so many gurus out there talking about get rich quick, do this and make tons of money. I made $1 million. Look at my Ferrari. Look at this. I mean, they're all get rich quick schemes. But you know what happens when you try to get rich quick? You get poor quicker because you lose sight of the marathon, the journey. So I think we can all agree, right here, right now, whether it's now or in the future, investing for the long haul is the proper way to do it. However, there are, in my opinions, a right time and a wrong time to go all in. There's a time to hold them, and there's a time to fold them. And as Warren Buffett so eloquently put it, he said the secret to investing, the easiest thing about investing that everybody should do is this. They should just buy low and sell high. And if they do that, buy low, sell high, they can't lose money. But how many people do that? How many people truly do that out of logic, out of human emotion? Very few. Most people, you might be one of them, not calling you out or anything, but hey, Jim, I know you're watching, I know we've talked about this. You like to buy stocks when everybody else is buying them, don't you? You like to go all into those stocks, all into that gold, all into whatever investment, whether it's Bitcoin or Ethereum, or maybe it's coin or whatever it is. You love buying them when everybody else is rushing in. When the news stations are saying everything's good, we just broke new highs. Oh, actually that just happened Friday. We just broke new highs in the S&P 500. It's the time, it's a bull market of the century. Do you think that's the right time to buy? I'm just being honest. Some of you are like, Chris, there's always a right time to buy. Yeah, but do you think that marks the most advantageous time to buy? When everybody else is rushing in. I'll tell you this, that's human emotion. It's FOMO. It's the fear of missing out. It's you getting all emotional because everybody seems to be making all this money because of fake realities that you're watching on social media or fake news that you're watching on whatever news station you watch. It's all smoke and mirrors. You see, when everybody's piling in, that's exactly when you should be getting out. There's an old story about how in the late 1920s, Kennedy was getting his shoes shined. And the shoe shine boy was shining his shoes, and the shoe shine boy's giving Kennedy stock tips. Now, didn't know it was Kennedy, giving him stock tips. And Kennedy thought to himself, if the shoe shine boy is giving me stock tips, maybe it's time to get out of the market. Now, as the story says, Kennedy sold all of his stocks and he made a fortune doing it. Now, whether or not this story is true or not, it does make you think. He acted on logic. If everybody, including shoeshine boys who are not investment professionals, are jumping in, the experts are jumping out. I'm going to prove it to you right now. Right now, all of you are probably like, yeah, what do I do next? How do I invest perfectly? Well, here's how you do it. You see there's a little button right there. It's called the subscribe button. Yep, looks like that. Hit that subscribe button, and there's a little bell. Whoa, coming in hot. Slash that. Smash that bell. So that every time I put a new video out, that actually took the camera out. Yep. Time out. Okay. Sorry, I got a little carried away. Kind of like you probably do, or like some of us do when a stock is going crazy, right? Or Bitcoin's going up, or they just released the new Bitcoin ETF and it's gonna just go to the moon. Yeah, it's called FOMO. So here's the thing. I gotta tell you, this is some of the things I've learned in all my years of investing. I've learned to only invest in things that I know, things that I like, and things that I understand. If you just eliminated everything else except for things you know, like, and understand, and you invested in them, and you used a strategy, not just all in or something like that, but you used a strategy like dollar cost averaging, a little bit in every single month, a little bit in bi-weekly, and you just set it and forget it, you probably would have a very high probability of success. And not only would you have a high probability of success, your human emotions would be tamed, like petting a nice little lion. He just purrs. Can you just imagine me petting a lion right now? Like just petting his mane and he's purring. I'm not worried about the lion eating me. No, tame the beast, man. You see, when you invest in things you know, like, and understand, you become like Lion King. Man, the kitty knows you. The kitty's not gonna eat you, you're its friend. You're the food. You aren't the food, you bring the food. Now, if you forget to feed the kitty cat, the kitty might get hungry and might eat your ass. What does that have to do with stocks and investing? Everything. Because if you get lazy with your investment strategies, if you start jumping into the FOMO and you forget to feed the beast will eat you. And that's what's happening right now. The beast, the stock market, is about to have its biggest feast. Because as the market set new highs, in a time when the economic certainty of this world, this country, is literally barely hanging on, everybody's jumping into the markets. Everybody thinks we're going to set new bull markets. Everybody thinks we're going to keep going and making new highs. On what grounds? On what basis? What could push the economy higher? Is the Fed going to print a whole bunch of new money? No, actually the Fed has vowed to keep rates higher longer. Yes, they've said they're going to lower rates into 2024, but it isn't going to be because things are super good. Inflation's still high. Jobs are being lost. Banks are cutting back. Orders for future cardboard boxes are down significantly. Why would orders for boxes be down? Well, because they plan to ship less. You see everything slowing down, but everybody's focused on fake news. Investing for the long haul will always be your best bet. But the biggest thing that will derail your long-term investment strategy is your human emotion. Because when the market tanks 20, 30, 40%, go back to COVID, go back to the pandemic, did you hang on or did you get scared? Because I'll tell you what happens. At about 20%, that's the threshold. When we hit 20%, the drawdown effect becomes very real. So if you lose 20, you got to make more than 20 to get back the original 20 you lost. If you lose 30%, you got to get back like 46%. If you lose 40%, you got to get back 63%. Think about that. It's called the drawdown effect. So if your portfolio were to go down 40%, your portfolio now has to make 63% just to get back to where you were because you have less money working. This is real. This is mathematics, folks. This has been around forever. But you see, people usually don't make it that far. I'll never forget when I was an advisor in 2008, the Great Recession. My clients were calling me, begging me to sell all of their positions when they were down 30, 40%. And I was telling them that's the worst thing you can do. You lock in losses, they become permanent. There's no going back after this. And they still did it because they said, I can't lose anymore. Human emotion is the most powerful thing. Why is it that not everybody makes money when they invest in their 401ks in the markets? Why is it that if investing for the long haul is almost a sure thing, not guaranteed, but a sure thing, why is it that not everybody's independently wealthy? Why is it that not everybody has all sorts of money because of the stock market returns? Because they sell 3 feet from gold, because they can't hang in there, because they were always focused on the growth but not ready for the decline. I can tell you the biggest problem with all financial advisors. All financial advisors have one job: to protect their clients' assets. Now, you may disagree with me. You might be like, no, my advisor's job is to grow it. No, because a monkey can grow your portfolio by throwing darts at stocks. They proved a group of monkeys beat the best stock analysts in picking. Why? Because in a bull market, all boats rise with the tide. But in a falling market, all boats come down as the tide goes out. And it starts to show scary things under the water that are lurking. This is what you have coming. These are the problems that will separate the men from the boys, the women from the little girls. It will be this defining moment. So when you think short-term, long-term, it's neither. It's in how you invest. And you should only invest in things that you know, you like, and you understand. You should also follow economic cycles. Ray Dalio, the founder of Bridgewater Capital, the largest hedge fund in the world, spells it out perfectly in his video, how the economic machine works. We are at the end of a cycle. We are going from a boom cycle to a bust cycle, from a good cycle to a bad cycle. I don't know what else you want me to call it. We're going down like the Titanic. Do you want to ride the Titanic down? Or do you just want to read about it in the papers and be like, yeah, you know, I was going to take that boat, but you know, I don't know. I didn't really know, like, or understand much about boats, so I just decided to stay on land. You get what I'm saying, right? Be smart, because what's coming is not going to be friendly to anyone that gets greedy in the markets, anyone that's playing the short game, anyone that thinks they know what they don't know. You're better off right now sitting on the sidelines playing it safe. And actually, let's transition to that. Playing it safe. What's wrong with that? What's wrong with playing it safe, right? You don't like what you see. You don't like the markets. You don't want to get slashed and cut and stabbed because the market takes all your money in your 401k. So what does it look like to sit on the sidelines right now? Actually, it's an interesting topic, actually. It looks pretty freaking good. Actually, it looks better than it has in most of my professional career. Do you know why? Because interest rates are up, which means safe assets, money markets, treasury bonds, heck, specially designed whole life insurance policies are all paying almost 5%. 5%. Did you know that when I was an advisor, if I made my clients 5%, I considered that a really good day, and so did my clients? Did you realize that the average return of the indexes is just a smidgen over 7%? Did you realize that all the basis of the rule of 72, or they call it the law of 72, okay, is all based on 7.2% return? Where do all these numbers come from? Historical data of the stock markets. If you can make 5 sitting on the sidelines in guaranteed accounts, or you can make 7 in risky assets at the end of a cycle, entering a bust cycle, what would you choose? Well, hell, man, I'm sitting on the sidelines. Because why are you going to jump in the river when it's raging, when you can just sit there and watch the beauty and be like, man, that's a strong-ass river. I'm going to wait for it to calm down a little bit, and then I'm going to go for a swim. Yeah, that's it. And you're going to get paid to sit on the sideline. So now let me relate to some of you, because some of you are long-term investors and you've already got long-term investments. And I'm just going to read off just a couple of them. Maybe you got treasury bonds because you've been listening to me talk about those long-term treasuries, but we're not playing the long-term treasuries just for the long term. You might own precious metals. Maybe you bought gold or silver or other precious metals. Maybe you're buying stocks and you plan to hold them 20 years, 25 years, because that's when you're going to retire. Great. Maybe you're investing in real estate or rentals. Awesome. Long-term investments, collectibles, memorabilia. I mean, art, rare and classic automobiles. Love my automobiles. Fine wine and liquors, luxury watches, which folks, I've had a bunch of people ask me about my watch. They're like, oh, is that a Rolex? Nope, it's a Nixon. Yeah, it's about a $500 watch. It was a gift. Devin Burr, Mr. Burr, gave it to me. See that? It says Chris Naugle, BYOB. This is my birthday present. This watch will not appreciate. But it sure does a nice job of telling the time, and the gold, well, you either love it or hate it. But all these long-term investments, do you know what they are? Do you understand them? Do you know exactly what role they serve in your portfolio, in your life, in your financial plan? If the answer is no to any of those, we've got to take a step back. We've really got to take a step back. And you got to start holding yourself a little bit more accountable because, hey, listen, the cavalry's not coming this time. You got to be a good steward of your money. There's no one that cares more about your money than you do. That financial advisor that you hired, he doesn't care about your money. He cares about the fees he's making on your money. Oh, by the way, when I was an advisor, I know I'm going to bear it all. Like, I got paid whether my clients made money or lost money. I always wanted to make my clients money because it was easier. And when I didn't make my clients money, in 2008 when everything was going down, it was hard, but I still got paid. Just always remember that. The suggestions you get from the advisor always go one layer deeper. Why are they making this suggestion? Is this really in line with my needs, my goals, and is this what I know, like, and understand? Because law number 3 of wealth is protect your wealth. First and foremost. Your advisor's probably not doing the best job of that. They're always trying to grow it, because that's what they're taught. But you need to be a good steward, and you need to protect those damn assets. You protect your assets, so protect your assets. It's the same darn thing. So I thought we would take this moment right now to talk about an interesting asset class, a safe asset. A safe asset that banks are the number one purchasers of. Yes, traditional banks. They own more of this than anything else. Not only do they own more of this, the top 1% of families, the wealthiest families in history, have used this. I mean, I'm talking Rothschilds, Rockefellers, I'm talking Walt Disney, Ray Kroc. I hate to bring this name up, but the Biden family, McCain's, I could keep going on and on. There's a lot of them. Morgans, the Stanleys, they all used this asset. And do you know what it is? It's about the most boring asset, but you know what? I think all of you pretty much know it. You just got to start to like it and understand it, and then the magic comes home. It's called whole life insurance. Yeah, talking about not just regular whole life though. Talking about a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. And I'm not talking about just putting money in this asset class and just leaving it sit there. I'm talking about actually using it to learn how you can become your own bank, how you can take back the banking functions in your life. You want the best returns? You want the safest, biggest returns you can ever get? That's what you wanted in the beginning, right? Those returns lie in your debts and expenses. Those returns lie in the checks you write every single month to those credit cards at 15, 20, 29%. Because every month they're giving away 15, 20, 29%. And if all you did is took back the banking functions in your life, if you took some of that money that you're putting out there in high risk stuff, paid off your debts, took the money you're paying to your debtors and put it back into its original source, should be a specially designed whole life, how much was your return? Well, it was whatever you were giving away. So if your credit card interest rate is 29% and you wrote the same check you write the credit card back to your policy every single month because you paid off the credit card, what's your return? Well, it's recycling and recapturing the 29% you used to give away. But not only is it recycling and recapturing the 29%, you're making money on the policy because the policy allows you to earn uninterrupted compounding interest even when you're using the money. So it's no longer a decision, folks. You no longer have to sit there and say to yourself, oh boy, I don't know what to do. Chris, I don't know what to do. Should I put money in that specially designed whole life or buy the index because they're all going up? God, I don't know what to do. You do both. You start by changing where the money goes first. You put it into the policy. Then you take the money from the policy and you buy the index or whatever investment you want. And then you take the returns from the index and you put them back into the policy. It's a circle, folks. The money just keeps circulating in your control. It is the and asset. You can have this, the specially designed whole life, and whatever investment you want. And you can make money twice, not just once. But you see, as soon as I said the name, whole life, you're like, those things suck. Dave Ramsey says they're terrible. Isn't it time that you learn something new? Isn't it time that you stop doing what all Americans do? You know, listen, Will Rogers said it best. He said the biggest problem in America is not what people don't know. He said the biggest problem in America is what people think that they know that just ain't so. I just planted a worthy idea in your mind, a challenge in your mind that you should act on. You can make money twice, not just once, by changing one thing, and that's where your money goes first. And if you did that, your money would grow in a guaranteed environment. It would be paid dividends each year, although not guaranteed. It would be growing tax-free. It would provide protection against creditors and liens. It would also provide a legacy for your family. But what do I know, right? What do I know? Well, I know that the game is about to stop. We're at the end of the cycle. Take it for what it is. We're about to go down the other side. And when we do, I promise you, you want to be positioned properly. So learn, apply, take that worthy idea, think about it every day. Make money twice, not just once. My name's Chris Naugle. This has been another episode of What Now? What's Next? Hey, if you like this video, you might want to check that one out right there. Yep, it's called BYO Bank. See you next time.